Good morning, ladies and gentlemen. I'm the pleasure of welcoming you to the Q4 2025 results conference of Photon Energy NV. To my left is our CFO, Stanislav Zeman.
Good morning.
We will run you through our results presentation, where we start with the business results, which I will do. Stanislav will run you through our financial results, and we will then focus also on the past guidance and the topic of the equity ratio, which is relevant for our bond covenant. Starting with the business results, electricity generation, our portfolio of power plants remained stable last year, with the only exception that we added 5 MW of new generation capacity, 3 new power plants that were connected in the first quarter of last year in Hungary. As some of you may remember, we disposed of our Australian assets in the fourth quarter of 2024. So last year, we had no additions, but except for the first quarter, but also no disposals. Looking at the fourth quarter, apologies. We had a decline in generation, which on one hand was owed to the fact that we did not have the contribution for the Australian assets, at least partially, because they did contribute to the Q4 generation results in 2024. But most importantly, we suffered last year from the temporary shutdowns, but also the limitation of production on many of our Romanian assets. The most significant impact came from 4 power plants, which are Aiud, Făget 3, and Săhăteni, with a total capacity of 24 MW. The good news is that Făget 3 obtained its license at the end of last year, and Aiud and Teiuș obtained the license last week and will start contributing as of next Monday. In the case of Săhăteni, we are still waiting for the license, and it's currently foreseen to be obtained in the month of May. So as a result, you can see that the most significant shortfall against plans comes from the Romanian market. In all other markets, we were slightly behind the expected generation volumes in the fourth quarter. As you can see, this, on one hand, we had a reduction in the volume. On the other hand, because of the disposal of the Australian assets, which were running on a merchant basis and had relatively low prices compared to energy prices in Europe, but of course, very significantly lower than those generation assets that are benefiting from feed-in tariff schemes. In Europe, our average per megawatt increased, and to a large degree compensated the decline in volumes. So we had a 34% increase from a weighted average of 136 euros per megawatt-hour to 182. What you can see in Australia is still a rooftop power plant with 200 kW peak that is running on a feed-in tariff that is receiving 176 euros. But you can see the bar for Australia for the fourth quarter of 2024, that was, of course, dominated by our utility scale assets, which we disposed of in the fourth quarter. So you can see the difference, supporting what I said before. So in the fourth quarter alone, we generated 2.8 million euros from electricity sales, which year-on-year is a 15.5% % decline. And again, to a very large degree driven by the sale of the Australian assets, but also a result of the limitations of production in our Romanian portfolio. Year to date, for the full year, electricity generation revenues reached 23 million, which represent a 7% decline year on year, again impacted by the factors I just mentioned. The estimated loss of revenues in Romania for the full year 2025 is about 2.5 million euros. So these are revenues that we did not generate, but would have generated if we did not have these limitations on production, which are of a regulatory nature. So a very significant impact, and these are revenues that do not have additional cost against them, so they would have flowed through the P&L fully to the bottom line. In Romania, in Hungary, the impact of regulatory changes, which as of January 1st, 2025, came in the form of a freeze of the indexation of the feed-in tariff. The impact is much less severe, but still reaches 131,000 euros for the full year of 2025. The EBITDA in the generation segment, as a result of the lower revenues, declined from 2.7 million to 2.4 million euros. So we had a volume decline. Prices that were realized in the fourth quarter, and the details you can find in our quarterly report, could partially offset the lower volumes. In terms of our portfolio composition, you can see that at the end of last year, just like at the end of 2024, it is almost 50-50 balanced between assets that are in some form of feed-in tariff, and that applies to all of our assets in the Czech Republic, Slovakia, and the vast majority of assets in Hungary. The balance in Hungary and all our assets in Romania are running on a merchant basis. The next segment is engineering, where we had, after the completion of our project in New Zealand, and due to the delays in the commencement of the construction of an EPC project in Romania, a year-on-year decline in revenues, quite significant. But as you can see, in terms of consolidated EBITDA, we swung from a loss in the fourth quarter of 2024 to a positive EBITDA in 2025. And also thanks to after a relatively difficult year in the C&I segment in Central and Eastern Europe, a positive acceleration, which we also expect to continue in 2026. Here, what is very important, these are relatively fresh news. We have announced that we are exiting our C&I activities in the Australian market. And in this context, we put 3 of our subsidiaries that were jointly executing projects in this space for external customers into voluntary administration. This is a process that takes typically 4 to 5 weeks. So we are now at the end of the first week of this process. The goal is to find a solution where the business, ideally, most likely in the hands of a new owner, will continue. And there are discussions ongoing, and we believe that in the next 1 or 2 weeks we will have clarity, and of course we will communicate to the market. Our presence in the C&I space in Australia has been quite difficult over the last 2 to 3 years. And in 2025, on the back of approximately 6 million euros of revenues, we had a negative EBITDA impact of 1.5 million, which with this exit should not be recurring and therefore contribute to our planned improvement in EBITDA going forward. In new energy, we had a year-on-year a significant decline in revenues based on partially lower capacity. So the contracted capacity in the fourth quarter was 282 megawatts compared to almost 400 in the same quarter in 2024. The balance was in the decline was a reflection of lower prices compared to 2024 in the fourth quarter. The second area of activity of new energy is trading in primarily the offtake of electricity from renewable energy sources, predominantly solar, to some extent also wind, and specifically in Hungary, also the supply of electricity to external customers, which are typically SMEs. And here, as you can see, we have been able to grow our activities in the fourth quarter, our business volumes. So year on year, we had a 50% increase in the volumes of electricity that were traded. For the segment as a whole, unfortunately, year on year, we have a negative result in the fourth quarter of minus 2.5 million, which relates to two events. One is in its nature a one-off fine of approximately 700,000 euros that we got from PSE in relation to the capacity market unit testing. However, the much bigger impact is, and here again I refer to public information that we provided earlier this week, that our dispute with PSE, the Polish transmission system operator, who is our client in the area of capacity market, is accelerating. And the background to this is that PSE is of the opinion that some of our clients in one of our largest capacity market units of 50 megawatts were not compliant with emission rules based on their deployment and use of diesel generators. And we believe that this is not the case. So when PSE basically sent us a statement in the second quarter of last year, we disputed that. This dispute went to the Polish regulator, who sided with PSE. However, we still have the legal path towards the courts, which is something we initiated on the 17th of December. And it has been our understanding and our legal understanding, the legal opinion we've obtained is that what I should mention as well is that if there's a failure in adhering to the emission limits, the entire unit needs to return the remuneration received in the given year. This dispute relates to revenues from 2024. So it is our understanding that this consequence of having to return the revenues is only valid once we are at the end of the legal process. That means there's a binding ruling by the court, and in this case, an administrative court. And this is how we feel very strongly about our view of the facts, and this is why we're also treating this liability as a potential liability, probably 3 to 4 years down the road. However, we have been informed by PSE that from our point of view, unlawfully they want to offset this return of revenues with ongoing revenues that we are invoicing to PSE, and we received information that they want to start doing so as of the January invoicing, which is due on the 2nd of March. That means next Monday. This is something we strongly disagree with. We have informed PSE about our view, and we've also sent a motion for an injunction to the Polish courts. So we will see in the next couple of days how this situation develops. However, this acceleration of this topic has forced us to fully reflect and create a 100% reserve for this disputed amount, which is the main reason why the result for the fourth quarter of 2025 is minus 2.5 million. We will get to this topic a little bit later. In operations and maintenance, we have had, as you can see, a significant increase in our business volume year on year, from just shy of 900 megawatt peak to over 1.2 gigawatt. In the fourth quarter itself, we only added 8 megawatts. However, there were assets that were taken over and we started the O&M just at the beginning of the first quarter. So the growing trend there is continuing, and we see strong demands in the majority of markets. Here, what I'd like to add is that we are, at this point in time, the only O&M photovoltaic O&M provider that covers the entire region of Central and Eastern Europe. So in our 5 core markets, Poland, Czech Republic, Slovakia, Hungary, and Romania, we're the only player who is active with their own teams in all these 5 markets. And here we can see a lot of interest by investors from within the region, but of course there's a lot of investors from outside the region that invest into assets across multiple markets. And the number of these players in our client list, and not only in relation to one market, but where we cooperate on 2, in some cases even 3 markets, is growing very dynamically. So what is also developing very well is in Hungary and now in Romania, we are offering, and in the case of Hungary, already providing asset management services. So that means we are not contracted as the O&M provider, but we're also providing asset management. We're providing asset management, and we're actually controlling the O&M provider. And a new area to which for which we're getting ready, and we are in discussions, is battery energy storage systems, where we are in discussions to provide also O&M, and in other cases asset management. So the growth going forward will not only come from photovoltaic, but also from BESS, and the pipeline of BESS projects across the markets that we cover is growing very dynamically. So this business line, we expect to follow this trend and become a more significant contributor in the next quarters and years. In terms of external revenues, the fourth quarter, and here external revenues means that the revenues that our own power plants pay to our O&M division is excluded. However, on the cost base, only variable costs are are excluded. So in terms of external revenues, year-on-year, you can see basically a flat line. This is, however, driven by a significant volume of one-off revenues that were generated in Q4, basically repair work for two external customers, which boosted the Q4 revenues in 2024. So adjusted for that, there was a growth in line with the contracted capacity. And in terms of external EBITDA, and in the you can see that the loss was reduced year-on-year from 650,000 to 280,000. This exclusion of group internal revenues, of course, has a very significant impact. And as you can see in the report for the full year, if we add back our internal revenues, for which, of course, there are corresponding fixed costs as well, we actually, in this business segment, generated an EBITDA of over 500,000 euros. Then the next business line is technology trading, where we are acting as a wholesaler for photovoltaic modules, inverters, and battery, and some other elements of balance of system, which, however, are rather minor. And here you can see that in terms of volume, particularly modules, we're very active in the fourth quarter of 2025. And when you look at the external revenues, which showed a relatively small increase. However, this increased volume in modules compensated the lower volumes in inverters and batteries. And what we, of course, appreciate most is that the EBITDA and the external EBITDA and group internal revenues are very, very small for technology. So well over 95% of volume goes outside the group. You can see a turnaround from minus 600,000 in the last quarter of 2024 to a positive contribution of 400,000 euros. Here we see, in this business line, we now see growing prices, particularly for modules, driven by changes in the export support by the Chinese government. And that is also allowing an increase in margins that we are able to generate in this business segment. So far, year to date, we are seeing very positive development. And as far as we can see, which means up to the end of the second quarter, beginning of third, we seem to have some good tailwind in this business line. Which concludes my overview of the business, and I'm handing over to Stanislav to guide you through our financial results.
Thank you, George. So on slide 12, you can see the financial results. As you can see, the consolidated revenues in Q4 2025 were more than 18 million euros. It means that it was 29.7% year-on-year decline. Revenues from electricity generation totaled in 2.8 million due to vehicle output. Other revenues decreased to 15.2 million, as you can see, with the sharpest decline in engineering and new energy segments. EBITDA was minus 3.4 million compared to minus 2.2 million in Q4 2024, affected by a 3 to 2 million provision related to the dispute with the Polish TSO, respectively PSE, as George mentioned before. Raw materials and consumable expenses fell to 7.8 million. Personnel expenses were 4.2, which it's minus 11.5% year-on-year, driven by the lower headcount. Other operation expenses amounted to 9.4 million euros. Other comprehensive income, 5.5 million euros, mainly from a positive PPA revaluation, and total comprehensive income, 2 million euros minus, an improvement compared to minus 4.2 million in Q4 2024, as you can see.
Excellent.
Yeah, please. Balance sheet. So brief balance sheets overview. Fixed assets increased to 223 million from 216, mainly due to commissioning of 5.1 megawatt peak in Hungary and land revaluation. Current asset dropped to 47, driven by reduction of inventories, assets held on sale, and cash and liquid assets. Equity fell to 52 million, down for 7 million roughly year-on-year due to the full year loss. Adjusted equity ratio, we have 25.1 after regulatory curve on adjustments. Long-term liabilities increased slightly to 169 million, mainly due to loan reclassification and higher deferred tax liabilities. Current liabilities rose to 48 million. So it's briefly about the balance sheet. Please, the next slide. Cash flow. Operating cash flow is 6.2 million versus 6.8 million in Q4 2024, supported by non-cash items included in the quarter's results. Investment cash flow is minus 1.6 million, reflecting project development and development expenditures. Financing cash flow, minus 5.1 million due to interest payments and loan repayments. Cash position at the end of the year 2025 is 3.2 million.
Thank you, Stanislav. In the next segment, we'd like to comment on the actual results versus our guidance in 2025, for 2025, where we guided revenues of 100 million and an EBITDA of 9 million. And as I was explaining earlier, one of the main item that had an impact is the provision, the full provision against the disputed amount with the Polish TSO of 3.2 million. And that is based on the previously explained acceleration of this matter. We were forced to make a full provision, which amounts to the vast majority of the difference between the guided 9 million and the reported 5.1 million euros. So this happened at the very late and towards the end of our, just before we're publishing the accounts. What you can see is on this slide is we are listing items that in our view are of a one-off nature, and we are confident should not repeat in this form, that have significantly depressed our revenues. So it's clearly the 3.2 million disputed amount with the Polish TSO. Also in total for the year, a 1 million fine from the TSO, with the most significant being recorded in the fourth quarter of approximately 700,000 euros. We unfortunately also ended the EPC project in Pukenui in New Zealand with a 1.3 million loss. So this project is completed and will not reoccur in 2026. But we also booked write-offs of intangible assets, most significantly related to software, with a total amount of 1.2 million in 2025. And we also wrote off the remaining value of our project pipeline in Poland. This was a relatively large portfolio of smaller projects. So if we adjust for these one-off items, then we would have been able to actually outperform the EBITDA guidance. We did not include on this slide the impact of the lower electricity sales revenues in Romania, which impacted us by 2.5 million. We also believe that we will still have an impact, as I was explaining before. We only obtained licenses for Aiud and Teuș now at the end of February. So clearly, we don't have revenues for these two power plants for the first 2 months. Săhăteni, which is a 7-megawatt power plant, so quite significant in our portfolio, will only most likely start generating revenues in May. So there will still be an impact from these regulatory changes, but it will be significantly lower. So, but at this point, it's very, very hard to assess whether this will be what this will amount to. However, again, everything else being the same, that means these power plants being in our portfolio, there should be a much more significant contribution to our top line and EBITDA from a resolution of this delay in obtaining the generation license. So, also increasing our earnings power. And these are marginal. We're bearing essentially all the costs related to these power plants. That means the depreciation, the financing costs, but have not been generating revenue. So this has been, of course, a very significant drag on our performance, which now with obtaining these licenses should go away, or is going away. So there's probably another 1.5 to 2 million that we would expect to generate on top of last year's performance. As mentioned earlier, the exit from the C&I business in Australia should also avoid a negative contribution of up to 1.5 million euros that also weighed on our performance last year. So while, of course, this 5 million of EBITDA are very disappointing and below our guidance, we believe that our true earnings power is significantly higher. And we are working very hard for this to become reality this year. In addition, we are also continuing with a very thorough review of our cost base, and that means we're also expecting and working towards a positive contribution to our EBITDA in 2026 through low operating costs. As you could see in our report, the headcount in Q4 was already reduced by over 15% compared to previous quarters. Headcount reductions are, of course, a very sensitive topic, but with a reduction of our footprint, for example, exit from the Australian market, and of course, also certain overhead capacities can be reduced. This has happened to a certain degree already, and we are right-sizing now our central functions. And we do see still significant potential to reduce costs, but not only HR related, where, of course, we have to make sure that we are able to execute all the businesses that we're involved in, and we want to continue in the markets where we are present. But there are many non-HR costs where we see potential to rationalize and reduce costs. So from an operating point of view, our goal for this year is to significantly improve our financial performance by, first of all, avoiding these one-off items, having a resolution upcoming in relation to our Romanian revenue base, and also the exit from Australia will help us in this effort. At this point, we are not in a position to provide a guidance for this year. So this is something we may address in the second quarter, once we'll have a higher level of confidence how business develops. But of course, we also need to understand what the resolution of the dispute with PSE, if there is a resolution, will bring. So this is currently one of our key areas of focus. I don't know. One of the key questions and is of course our bond covenant covering our equity ratio. The covenant is structured in such a way that we're calculating an adjusted equity ratio, which you can find in the prospectus, and we have a so-called regulatory carve-out, which means that if on any of the PV power plants that are in our portfolios there is an impact from a retroactive change, we can well, our equity is adjusted for the impact. So here you can see the cumulative or the values that are the result of these regulatory changes, both in Hungary and Romania. So in Hungary, as I mentioned before, it comes in the form of a 5-year freeze of the indexation of the feed-in tariff, and in the case of Romania, it was a change of regulations that led to a loss of revenues. At this point, some of these losses have already have been incurred, but they also, of course, have an impact on the valuation of our power plants. That means without those retroactive changes, those power plants would have a higher carrying value in our accounts. So specifically, the impact on the valuations is smaller in Romania with 167,000. The 5-year freeze of the indexation has a much bigger impact on our Hungarian power plants in the form of to the tune of almost 1.9 million euros, whereas in Romania it's reversed. We have incurred, as mentioned before, already 2.5 million in lost revenues due to the regulatory changes, whereas the impact in Hungary, as mentioned earlier already, is relatively benign in comparison of 131,000 euros. So, but the total impact is around 4.6 million euros. And when we add this adjustment back to our equity, we still have an equity ratio of 25.1%, which means we are above the bond covenant. Very close, of course, but we are above. Here you can see which parts in our equity statement are impacted by these regulatory changes. The piece of news that of course is of primary interest is that the escalation of our dispute with PSE and the risk of not receiving revenues in our capacity market business in Poland for the next couple of months. So an offset of these 3.2 million plus VAT, talking about 3.9 million euros, would represent a complete loss of revenues, at least for the first 4 months. Most likely it will still include parts of our remuneration for May. Of course, represents a significant strain on this business line, which to date has been actually a good contributor to our consolidated results. And the what appears to be the final decision to offset was communicated to us at the end of last week, and it put us into a very tricky situation. Of course, we are currently in a situation where our liquidity is comparatively low to previous times, and in order to preserve our ability to react and absorb the impact of this, what seems to be final decision of PSE. That means to maintain continuity. We have, of course, operating costs there. We have, in terms of staff, systems, and of course also customers with whom we have contracted. We had to make the very hard decision to delay the payout of the coupon on our bond, which we communicated in what, of course, at the very last moment, but it was linked to this piece of information that we received very shortly prior to the coupon payment date. The situation with PSE is dynamic. I explained before that we are taking all legal steps to avoid the situation, including a request for an injunction. And I would say the next 1 or 2 weeks will show how the situation develops. We have so the questions that we have received so far are related to this topic. So we, just following what I just said, we will see. We have to wait for how the situation develops around the green bond. We are, of course, working very hard on increasing the liquidity position. We have communicated before that we are focusing very strongly on disposing of our development assets in Romania. We also have discussions around some of our operating power plants that have not been financed on a long-term basis. What I can confirm is that we have interested parties. Those discussions are ongoing, and we do expect some results from this effort during the second quarter. So we are working very hard on increasing the liquidity position, irrespective of what of this development in Poland in relation to PSE. But we are today not able to give a specific date. Of course, we understand this is it is a very unpleasant situation, and we have so far always adhered to our covenants and paid coupons on our bond. So this, to an extraordinary situation, we're working very hard. I would say, dare to say, day and night to rectify this and pay the coupon, but we cannot give a specific date. So the moment we are in a position to do so, at least give a specific date, we will of course inform the market. But more importantly, we'll try to pay the outstanding coupon. I see there are some questions from 2 investors who seem to have received the coupon payment from the custodian bank or the brokers. And this is information that is secondhand. I have not spoken to any of the brokers, but apparently several brokers are pre-funding coupon payments and dividend payments. That means they're not waiting until they get paid by our custodian bank, but they transfer it before receipt. So this is the reason why you may have been credited the coupon. Again, what I've been told by people who understand this process is better than me, there may be then a reduction when basically your broker or your custodian does not receive the funds from our custodian bank. So you may have received this coupon, but maybe the next couple of days, it may actually be deducted again. But please contact your broker. This is what we've been told, but it needs to be verified. But it may explain why you have received the coupon. In terms of our cash position across the group, we are at the level that is comparable to what we have reported in the as of the end of the year. This is the answer to the question, what our cash position is as of today. There's a question about the bond buybacks. So while we fully understand how beneficial it will be to buy back the bonds, but of course, at this point in time, our priority is to maintain operations, given the circumstances, particularly in Poland, but just as importantly, to pay the outstanding coupons. So buying back bonds and not paying the coupon is something that we definitely will not do. The last question. So is the revaluation models for Hungary, Romania, and Slovakia still in progress and will be part of the auditor statements? Well, of course, we have updated our valuations as of the end of the fourth quarter. And so they're reflected in the accounts that we in the statements we just published and presented today. The models that we're using and the input factors are coordinated with our auditors. Of course, there will be a final review, but as of today, we don't expect there to be any significant change. Okay, details of the Polish claim. I will try to explain this as best as I can, the background, and we will try in the next couple of days to make available a more detailed description. The Polish capacity market was established by the Polish government, I think 8 or 9 years ago. This is pretty much a copy of the model from the UK, and the main purpose is to have a legal title to provide support to the coal-fired generation units in Poland. And so the vast majority of capacity market payments goes to coal-fired generation in Poland. The part that we operate in is demand-side response, and I would dare to say it is a bit of a fig leaf, so that it doesn't look like it's only for coal-fired generation. And in order to be able to support coal-fired generation, the Polish government managed to get an exemption from EU CO2 emission limits for any generation capacity commissioned before 2018, which covers, of course, all the coal generation units in Poland. Any generation unit used in any of the parts of the capacity market has to, after that date, has to comply with the limits. The remuneration paid through the capacity market mechanism is considered state aid, and this is why it has to be approved, and any changes have to be approved by the EU Commission. So this, of course, also applies to our to demand-side response. So the way it works is through auctions run every year. We contract a certain volume of capacity. So in the fourth quarter, it was 282 megawatts with the Polish TSO. And the service we provide is if certain stress levels in the Polish grid are reached, the Polish TSO can call the service that we coordinate, which is the coordinated reduction of electricity consumption by our clients. And so what we do is we create so-called capacity market units, which range from 2 to 50 megawatts, where we on the other, which contract with the PSE, and on the other side we contract with energy users ranging from SMEs all the way to steel mills, and flexibility from our customers, of course, can have multiple sources. One of them is that they simply switch off equipment that they're using, or even the lights in some cases. Going forward, it will be more and more achieved through batteries. But one flexibility element is on-site generation, and this can be, in some cases, these are cogeneration, but also a lot of customers are adding diesel generators, and either they already had them before we contracted with them, or they're adding them later. And these diesel generators that were commissioned after 2018 are subject to the CO2 limits, and these CO2 limits can only be achieved if either fully or at least to a very significant degree, these diesel generators are run with biodiesel. And every year we have to state to PSE that all our customers are adhering to these limits. So on one hand, it has also become obvious over the last two years that it's very hard to police, because when a customer decides to add a diesel generator, he has to inform us, which is not always happening automatically. But there's also certain exceptions, and so one of the problematic assets that led to this dispute is actually a customer of ours who added a diesel genset primarily for heating in winter, and for this there is an exemption as long as they are not visibly used in this service that we provide to the TSO. So there are these tricky areas, and basically the dispute arises from, in total, 3 assets or 4 assets that where it is in this technical gray zone, and where we have the strong view that we were compliant. The problem is the consequence of non-compliance by even one asset in our capacity market unit is a return of revenues for the entire year. So essentially, and unfortunately in this case, a 50 megawatt unit with annual revenues from the TSO to us in 2024 of 3.2 million euros is, from the point of view of PSE, affected. So basically we had assets that were non-compliant. So the view of the TSO is that they were non-compliant, and therefore we need to return the revenues. From a technical point of view, we have the view that we did not violate the emission rules, or our customers did not, and so this is the source of the dispute. So when the TSO informed us that they're non-compliant, asked us for the return, we appealed that decision with the energy regulator, URE, in Poland, who then on the 3rd of December decided to side with the PSE's argumentation. But the legal process is such that we still have the path to administrative courts. And this is what we did. We filed on the 17th of December, and the expectation was that this case, well, first of all, we feel quite confident that we have a very strong chance of prevailing in this court procedure. But secondly, we also are expecting that this will take, as there are two levels. So before a final ruling occurs, we will probably take 3 to 4 years. And of course, in administrative law, the disputed amount only becomes due when there's a final court ruling. And PSE seems to take has taken a different stance, and is now basically unilaterally, and from our point of view, unlawfully trying to offset the disputed amount, which again, represents approximately 4 months of revenues in 2026. And of course, the impact is extremely significant as we have a very high fixed cost base in this business line. Well, yes. So our expectation is that the court process can take between 3 to 4 years before there's a final ruling. What we have done now is we have sent a request for an injunction to the court to issue against PSE so that they cannot offset the disputed amount with the revenues that there was for the ongoing provision of services. By law, courts have 7 days in Poland to react to such a request. Reality seems to be different, so it can take longer. But basically, we have to see how this develops. We will, of course, pursue all our legal options and procedural possibilities as actively as we can. The question before is about the refinancing of our green bond. Of course, this the situation that has occurred over the last couple of days. Our original plan was to address the refinancing after the publication of our audited results for 2025. We, of course, understand that now we're in a different situation with developments in Poland, with the fact that our coupon is delayed. And all I can say is that with a sense of urgency, we are, first of all, looking at improving our business performance, maybe even somewhat more radically than before. And at the same time, we are reviewing the options that we have. We are, of course, aware, and one of the questions that was sent to us before the call took reference to what is going on in the German bond market. So we're at this point in time not the only renewable energy company that has issued a bond in Germany and is not doing very well. So we are aware that and I will not name names, but there's 2 or 3 companies that have commenced a discussion with the bondholders. So we're not at this point, but we are aware that this is a possibility, and it is definitely one of the things we will be contemplating. So it is a combination of improving our internal performance, which I think is and cash flow generation through a combination of reduction of cost, generating cash through the sale of assets. But we will, of course, also have to look at the funding structure of our group. I think in terms of the R word, restructuring, I have probably said everything that we feel comfortable doing at this point in time. But we understand it is a difficult situation, and it requires swift and thorough action. So, and we will inform the market as soon as there's something reportable in this relation. Well, there is a question about what happens if the court denies the motion, or whether it has what the impact on the parent is. So I think if we have if this offset crystallizes and there's no stay on it, we'll definitely have to think very hard what to do with the entity affected. One of the key issues, but in any case, we have in the background, I mean, we have people that work in back offices. We have systems that are used not only for the capacity market, but also for our electricity trading, and not only in Poland, but also in Hungary and the Czech Republic. So there are elements of this business, a new energy that need to keep going, and of course that means they incur fixed costs, and those we need to. So in essence, they're mission critical for the other parts in new energy, and those we have to maintain, and with a significantly lower revenue base, but also contribution base, and this is what needs to be covered centrally. So so this is the main area where it has a drain on central cash flow. So from our point, and on our end, we are, I think, at the end of our presentation. Are there any more questions that? As a question about audit. So sorry, the audit is ongoing, and yes, given the current situation, going concern is of course a key topic. So the question on Australia and the voluntary administration process. Yes, we did describe as the impact as minor, and yes, it is correct that the intercompany loans that were provided from the holding or other entities in the group to the companies that are currently in voluntary administration are so they're not de jure written off, but of course they are eliminated on consolidation, firstly, and secondly, they essentially reflect losses of these Australian entities in the past. So they've been already reflected in our past financial statements. So while we don't expect a complete zero, but whatever the write-off requirement will be, will not have an impact on the. So in our consolidated results, we run them basically at zero. So any positive result will actually be positive, but we don't. However, at this point, we don't expect any material in the context of our balance sheet or equity, a material impact either way, whether neither positive or negative. There's also a question about the value of these receivables, which at this point we cannot report, but I think once the VA process will come to an end, we will be more specific. It is a significant amount, but as I said, the impact on a consolidated basis will not be material. Okay, so if there are no more questions, then I would like to thank you for your attendance and your interest. It is a very challenging time, and of course we are very sorry about the delay in the coupon payment, and we are really working very hard to get to a point where we can not only make the outstanding payment. But of course, our goal is to get back to what we have been able to do for over a decade, which is timely payment of all our coupon payments. So if not for this extraordinary situation, we've understand how important it is, and we know that a lot of investors have shown a great level of trust in our business, and this is really something that we don't was not part of our plan. So we are addressing it as fast as we can, and as at the moment we cannot give an exact timeline. We will. There's a commitment from us that, of course, we will communicate any news that can clarify the situation in terms of timing. So thank you very much for your interest, and we do hope that on our next call we will have more positive news and not only in terms of numbers but also circumstances to report. Thank you very much and have a great day. Thank you.
Bye bye.